Hi, I'm Tim Ogden, Managing Director of the Financial Access Initiative, and part of something called the Sentinel Project, which was a project that I launched with a bunch of other microfinance researchers towards the start of the pandemic to track what was happening to microfinance institutions, how they were coping with the pandemic. And one of the participants in the Sentinel Project was Barbara Magnoni, a longtime friend and a researcher who's done a lot of work with MFIs throughout Latin America over the last 20 years. And she was talking to MFIs in various parts of Latin America, but there was a hole in what we were doing, a hole in Central America. It's a part of the world that doesn't get that much attention, but I think offers a lot of relevant lessons for microfinance globally. Not every part of the microfinance world is like South Asia or is like some of the older, more established organizations in Central and South America proper. So Barbara and I decided we needed to know more about what was happening in Central America with those organizations, particularly as they were using digital tools to help respond to the pandemic. So with the support from the MasterCard Center for Inclusive Growth, I asked Barbara to do some in-depth research with Central American MFIs so we could understand those better. So let me introduce Barbara now. Barbara, welcome.
Hi, Tim. It's nice to be here.
Thank you. So Barbara, let's start off with some context because, it's not as if a lot of the audience necessarily knows a lot about the Central American context. So tell us first about what the situation in Central America is. What are the MFIs there like?
Yeah, Tim. So we actually partnered with Remarkably, which is a network of MFIs in the region. In total, they have about $1 billion in assets and about a little under 1 million clients right now. So, small MFIs scattered around the regions, and they really vary both in terms of regulatory status, in terms of sort of focus and outreach. Some are more commercial, some are a little bit more social. So there's a really broad range out there. What we did was we surveyed those institutions, and we're able to survey 41 of about 56 institutions in the network across 4 countries. So we focused on El Salvador, Guatemala, Honduras, and Nicaragua. And in addition to the 41 MFIs that we surveyed, we had in-depth interviews with about 12, choosing a really nice mix of MFIs and regulatory statuses and sizes, and then held focus groups with loan officers in 4 of those MFIs and spoke to clients in those same 4 MFIs. And what we kind of landed on was a sample where 59% were non-regulated, either MFIs, NGOs, and co-ops. 41% was regulated institutions. And our entire sample comprised of about 82% of the total Remarkably portfolio, which was really great because we covered a lot of ground. One thing that I'll kind of emphasize, if you look at the map of the institutions that we sampled, a lot of them are based along border areas, which is another sort of interesting piece around this segment, that this is a corridor. Obviously, it's a migrant corridor. And there's a lot of border activity, both commercial activity, migration activity, et cetera. And one other thing I'll mention is that the MFIs kind of fell into 3 categories. The majority were larger MFIs, but we define large in a sort of small way, with MFIs over $15 million in their loan portfolio. And most of our quantitative sample comprised of those. The remainder were what we would call either medium or small, and the medium ones had loan portfolios between 4 and 15 million. The small were under 4 million. We kind of oversampled them in our 12 interviews just to get a nice broad understanding of what was happening there.
Now, you mentioned in the border areas and migration, and that's a whole other dimension. I think Central American MFIs have a lot to teach the rest of the microfinance world, as we're likely to see a lot more climate migration in the future. Central American MFIs have been dealing with the realities of migration at scale for a lot longer and how that affects things. But that's not our topic today. Our topic today is really about digitization. And yes, Central American MFIs are smaller than some of the really big global players, But I do think they have important lessons, and they're representative of many parts of the microfinance sector globally. Not everybody is really big, not everybody is at scale. And part of the reason I was interested here was, I came into the Sentinel project in the first place really worried about how MFIs were going to handle this new world. And in as you were describing, these MFIs in Central America weren't the ones who have lots of resources to hand. So what did you find? How did these MFIs handle the pandemic?
Well, as you can expect, I think what we saw globally, a lot of that was reflected in this region as well. MFIs did rush to digitization in one way or another. 33 of the 39 who kind of answered this question about digitization said that they implemented some kind of significant change in their digital infrastructure during the pandemic. So they were really driven by that. And the main driver was lockdowns. Lockdowns were very severe in the region, and MFIs and their loan officers lost access to clients. And so they had to kind of scramble to figure something out. And what many of them did was focus on two things. One is the client facing kind of front office digital solution related to mostly either using WhatsApp or other kinds of tools for communicating with clients, as well as developing software for loan officers to serve clients remotely. And then they also worked on back office processes and back office tech to kind of streamline processes, make them less physical and a little bit more efficient. In addition to that, though, we saw changes across the board. So we also saw some MFIs working on direct MFI to client technologies, as well as back office kind of stronger hardware and core banking system modifications and upgrades.
Now, I think that's an important distinction, because often when we talk about digitization, the focus is on what you might call the last mile, like the app. How do people interact, and the competition potentially between MFIs and pure digital fintech app lenders. Did the MFIs sort of go into this thinking about the entire range of digital technologies? Did you talk to them about different parts of digitization?
Yeah, we definitely talked to them about defining what they mean by digitization before even starting this, because we didn't want to limit it to that front-facing fintech solution, but really understand what they were seeing and what they were needing in terms of digitization. And that's why we broke it down into these four kind of general categories, starting from the core banking, the really boring stuff, the core banking systems and hardware that is so important in that process, as well as back office digitization, all these like loan processes that are so manual in so many institutions can be really cumbersome and require people being in offices and people being physically present and close to each other, all the way to loan officers communicating with clients or agents, and then the final sort of fintech direct to client app. So these are sort of four categories that we explored separately, but also try to understand how they fit together.
Now, I'm on the record in a couple of places saying this was going to go really badly. The pandemic was going to go really badly for MFIs, and I'm on the record in a couple of places now. I was like I was wrong. And most MFIs, or many MFIs around the world, were remarkably resilient. We're remarkably agile here, and even what I'd heard from the Sentinel project, I was still quite surprised what I saw here and how quick the Central American MFIs were to respond. But I still have a hard time believing that it was all sunshine and rainbows, particularly given the variety of MFIs and the different sizes and scopes and rurality of some of these MFIs in Central America. So presumably there were people who did better and people who did worse.
Yeah, for sure. So, the first thing I'll say is that the MFIs, one of the things that really helped was that they were able to implement a lot of their changes with relatively few resources. And I think that's sort of something that surprised us as well, where They use local programmers, even a lot of people on staff to implement some of these changes. So they didn't have to spend tons of money. They hired local consultants. And, even some of the sort of more donation types of projects, like their program with Recami Fanada on digital finance, they were developing kind of strategies for MFIs. The total cost of those TA programs was $30,000, and there was a 50% cost share. So an MFI would really just put in $15,000 to get this like digital strategy for them. So these are small amounts that were relatively accessible for everybody. That's not to say everybody had the same access, but it helped. That led to, in a lot of ways, some really big improvements on the bottom line, because they were able to kind of hit some really necessary pieces that were critical for A, keeping business as usual, and then B, streamlining and improving operational efficiency. And those two things together were really impressive, because they allowed MFIs to, in some cases, increase profitability. So in Guatemala, El Salvador, and Nicaragua, managers told us they were more profitable as a result of the pandemic. And in Honduras, perhaps declined less than they might have in profitability as a result. Returns on assets either improved or stayed relatively healthy in all of these countries. And you can see operational efficiency being a really big piece of why. And that was directly related to these process changes and back office changes that they implemented at a relatively low cost. Another driver was kind of growing the loan portfolio and increasing loan sizes, which we saw in El Salvador and Honduras. So those are kind of nice surprises, but also nice outcomes that came from relatively low cost interventions.
I'm going to push though on this question.
Yeah.
Everybody?
Not everybody. So yeah, so not everybody. So we, going back to the categorization that I mentioned earlier with the large and networked MFIs, the medium and the small. We grouped large MFIs, or 15 million and up, large MFIs with networked MFIs for one main reason. They had access to similar resources. And the reason was that some of the networked MFIs, even if they weren't huge, had access to their network's resources. So they were able, for example, to strengthen core systems in one case because the network offered them sort of a group deal, and could access that sort of more fundamental, robust change in their digital systems than a smaller or medium-sized MFIs. The larger MFIs and the medium, to much extent, partly because of this program that I was referring to, had some kind of digital strategy in place. And so they were able to say, okay, we were going to do this in 2024 or 23 or 25, let's do this now. But we had a sequence, we had a plan in place, and we were able to implement that. The smaller MFIs were caught a little bit more off guard. They weren't ready. They didn't have that sequence in place. And so they kind of scrambled. And again, the resources needed for some of these adjustments were small. So all of them were able to do something, but that something was not necessarily kind of well thought out as part of a long-term strategy toward becoming a much less kind of brick and mortar organization toward a more digital organization. Whereas those larger MFIs and some of the medium ones had that, and were just able to accelerate it. We found that the medium ones focused a little bit more on those back office processes, which was great. And the large ones were more thinking about, I use this image of building a house, like building that foundation first and making sure that that's sturdy, and then kind of layering other layers on top of that, which, reflects both greater resources, know-how, access, and a much longer term vision.
I hear that. And, again, it's great news that many were able to do so well. But it also, I'm the kind of guy who finds a dark cloud in every silver lining. And, something particularly you said there, Barbara, about the foundation.
Yeah.
And this is a particular concern when I hear people talk about, oh, the better the foundation, the better able they were to adapt, is because funding foundations has always been a challenge, not just in microfinance, across the board in nonprofits or anybody that requires subsidy. Is funders like to fund the addition to the house. They don't like funding the foundations of the
Yeah.
house. And you mentioned core banking software. That's sort of the foundation of
Yeah.
a lot, of an MFI's ongoing ability to do this.
Yeah. And hardware and servers. I mean, there's just so cloud technology. There's so much of that that is required in order to then layer on these apps. And when you don't do that, what we heard loan officers in particular, because so much of this was loan officer facing solutions, complain about is bugs. There was bugs in the system, or it didn't work well, or it was slow, or when we were out in remote areas, it wasn't connecting well. So without having, those strong core foundations, all the other stuff that's sexy and maybe more donor friendly because it seems more innovative,
Right.
is not going to work completely. And the risk of anything not working in our market and with this target clientele, and even with this client, this target staff, is once you're disappointed, it's really hard to go back, right? So you don't want to disappoint people, and have them lose trust in a process or in a system, because it's much harder to rebuild that trust. So those foundations are boring, costly, bureaucratic, but they're no longer that luxury that we used to think about. It's not like I'm buying a fancy new computer because I want something, you know, modern and pretty and whatever. This is like serious stuff that is required in order to process a lot more data a lot more quickly, in a much more complex way.
Mm. So that being said, with the kind of results, greater profitability, or at least reduced profitability, some efficiency, was everybody happy with the outcomes?
Yeah. So, well, maybe I'll just step back for one sec and say, clients themselves, luckily were being served well by agent networks. And that is something that, this region, as you were sort of trying to compare it to other regions, this region, while not as advanced as South America or Mexico in the development of agent networks, has put a lot of time and energy into it in the last 5 to 10 years. And, that was a very useful, crutch to maintain contact with clients, even for some of the smaller MFIs that were able to plug into networks and didn't have to develop their own network. So I'll sort of put that in as a caveat, because clients do feel comfortable with those networks. They're more physical. We didn't have to go totally remote. But sort of going back to your original question, um, I like to think of the results of this as, well, let's see, kind of surprising in that it does look all rosy, but then when we asked, would you go back and do the same thing? Almost half of the institutions we talked to said no. And that was a really interesting
Mm.
finding. I was very surprised by that. And I think, as they reflect and go back and say, what did we do wrong? It sounds like some of them are really understanding that, like, going all the way, to that client facing app was probably premature, that focusing on those intermediate steps, the loan officer with the client, the agent with the client, and some of the back office processes made a lot more sense than rushing to solve that, lockdown kind of remote problem, that was so immediate. And that was sort of, for us, one of the more interesting findings. And a lot of that, I guess, shouldn't be surprising, because we've seen all around the world clients still resisting, not having a physical interface on some level in the microfinance space. Digital takes time, and teaching digital takes time. And that's something that we've seen overall. I think where we saw success and where the MFIs are really happy and feel like they haven't made mistakes is in efficiencies. They are, recognizing very much that, having this more kind of streamlined process and digital process on the back end has led to some cost savings. Some of those efficiencies, however, we have to be careful about, because it's the whole working from home, COVID thing, and maybe that'll change a little bit.
Mhm.
But undoubtedly there were some systemic changes that were really good.
And again, acknowledging my ability to look on the dark side of the street
Yeah.
always. Um, part of the point of microfinance was to be inefficient. It was, if it was efficient to serve these kinds of customers, the banks would have already been serving them. The reason they weren't serving them was because it's inefficient to reach these kinds of customers who aren't comfortable with the banking system, that you have to hold their hands, and they need small amounts, so you can't make a lot of money serving them. So I would have expected Central America be the kind of place where there would be a huge digital divide. And it seems like actually it wasn't nearly as big as I would have expected. But I do also hear that there's some portion of that still exists.
Yeah, for sure. I mean, in that same question that we asked about doing things differently, the regulated MFIs were more likely to say they would not do things differently. So they were happier with their choices than the unregulated and the different categories that we interviewed. So definitely, having that strategy, having that sequencing, having those resources led to better decisions, and to kind of a happier outcome or a better outcome than some of these smaller MFIs. And that is where you start to see that digital divide. The question might be, does it matter, right? Like if these larger ones are doing a good job in serving, is that enough? And I think what we have seen and working with it at Camif, who's a great partner on this because they are so close to the end customer, is that it does matter. Smaller MFIs reach more women than larger MFIs, and reach more rural clients than medium and large MFIs. And medium MFIs also have a little bit more of a female focus. So the larger MFIs are not reaching those, last mile customers that we're hoping to provide access to with microfinance. The other thing that I showed you was that border photo, or the image of all the branches. And, if you think about not just the fact that so many of those are on the border, but that they are in slightly harder to reach areas. And in the context of Central America, that is a region that is incredibly vulnerable to climate and incredibly vulnerable to kind of political risk. Being able to reach people who are hard to reach in an emergency is a huge social service, right? It's a huge value. And losing that access, where maybe a large MFI doesn't want to expand to that tiny little town in the mountains because it's not worth it. It's a lot of work. It's a lot of effort. You might even have to learn a whole new language, or supervise people who speak a whole new language, and it might just not be worth it to, get another 300 clients. Those smaller MFIs are really important in achieving that last mile goal that we have.
Let's wrap this up, Barbara. If we're to sit down and say, from this work, what should funders, what should MFI networks, what should policymakers take away from this research?
Yeah, I mean, some of the client level stuff is not very different from what we've seen elsewhere, where clients are still kind of behind on this journey and need a little more hand-holding, a little more kind of balance between tech and touch, and both research, products, strategies, journeys that allow them to move along that in a more comfortable way. That's something we've seen across the board. Where maybe this region offers some interesting new opportunity is on remittances. Some of the clients noted that, their remittance services are very disconnected from their other microfinance services, and interoperable payment systems that include remittances and microfinance in sort of the same place might be an interesting opportunity for this region. And there may be some strategic partners that are prepared to do that, either directly with the MFIs or through networks. So that's something that we've been thinking about. A lot of the advisory that we saw on building kind of a digital strategy and helping institutions move along that strategy seemed to be very useful. I would say that some of the MFIs that were smaller also expressed some frustration in identifying providers, software providers, or other partners, both in terms of finding good value, good quality, negotiating pricing, et cetera. And those are things that outsiders might be able to help with. With all this, of course, comes data security, consumer protection stuff that, is so important. I think for me, one of the more exciting opportunities that I've identified here that is the hardest to work on and requires kind of all hands on deck is saying, okay, these small MFIs are important. We need to acknowledge that they have a role and an important role, but that maybe those core systems, those big foundations are just too much of an investment to keep them sustainable. And so thinking about ways to create synergies, with like layered banking products or banking as a service that, front facing MFIs can tap into, or other kinds of, more mass solutions that allow for small customized outreach could be really interesting in this region. It's certainly a region where I would try to tap into those kinds of opportunities, both because of the market context, the size of the MFIs, but also because they have a really strong network that you can work with, so that you're not just working, with one or two institutions at a time, but you can work with a whole bunch of them and really create some synergy there. So that's where I see sort of the most exciting opportunities.
Well, thank you, Barbara. There is going to be a full report on this with all of the data and more than we've talked about today. So keep an eye out for that. And thank you all for joining us for Financial Inclusion Week 2022.